Well, welcome to this webinar on trends in ESG, kindly sponsored by Berenberg. For the structure of the conversation today, we're going to use a recent Berenberg client survey, which contains some very interesting results. And first of all, I'd like to come to Richard Brass. Welcome, Richard.
Hi, David. Thanks for having us.
So perhaps just to set the scene here for the conversation today, you could tell us a little bit about this client survey that you conducted that we're going to discuss in this session.
Yeah, sure. Look, at Berenberg, ESG is not a new investment concept. It's something we've been doing for many, many years. But it's clear that as time has gone on and as more information has come into the public markets, that it's important to be able to go to the investor community, to go to your clients and engage with them and ask them what their opinions are. And particularly on a subject like this, it is still remarkably fluid, as I suspect we'll come on to discuss during the sessions today. We did a survey in 2018. We focused that entirely on the SDGs. We decided to update it in 21, not just in terms of our knowledge on the output from that previous survey, but also start broadening out some feedback around subjects like COP, subjects like B Corps, subjects like COVID. And we were delighted with the response rate. It was sitting at around 11%, so we had about 112 responses. 38% of that was in the private client space, 18% institutional, and then a range of different type of investors in between. So we got a good, diverse set of responses. And geographically, just under half was from the UK, just over half was from Germany, and a balance in between. So we like to think that the survey was, a good insight, if you like, on where we are right now around interest and appetite and engagement around the subjects of ESG and impact.
Thank you, Richard. Just picking out some of the key survey results, we're going to use those as a conversation starter in a number of different sections as we walk through this webinar. One of the most interesting ones was that 55% of participants believe impact is equally important to returns. Perhaps I could just bring Melanie Griffiths in from Equium to look at from the fiduciary perspective. And perhaps, Melanie, you could give us a sense of how fiduciaries balance return versus impact, the return versus impact conundrum that has been set out here in this statistic.
Sure, David, my pleasure. So the impact versus return is something that many of our beneficiaries find worrying and sometimes walk away from ESG because they're worried about lower returns. To me, it's not something that makes sense. You shouldn't be giving up returns for ESG. ESG is something that makes good business sense. And it's not something that's new. Maybe the term ESG has been coined more recently, but I think investment managers have always been concerned around ESG factor. Perhaps there was more of a focus on governance, because ultimately if a company is badly run and doesn't make good decisions, then that will impact on performance. What perhaps has changed is that there's more of a focus recently on the sort of E, the environment, and S, the social side of things. But the direction of travel is such that if you don't pay attention, if the company doesn't pay attention to ESG, the cost of capital will increase, taxes will likely increase given where we're going, lawsuits potentially, which again all go to the bottom line. So for me, it's not something impact versus return, but very much if we want to consider the best financial interests of our beneficiaries, then we need to consider ESG. Now, what you tend to give up when you invest in ESG is liquidity. I would say more than return. So I think the survey focuses mostly on the public markets. I think it's self-evident on the private market that you're giving up return. But even on the public markets, if a company is focusing on ESG, it tends to be either a growth company, where you expect them to do well in the future and therefore maybe not so much dividends now, or it's a company that perhaps needs to transition, and that means heavy investments and likely lower dividends. And so for us as fiduciary, we always have to consider are the different needs of different beneficiaries. And often they may be in the trust deed, or some beneficiaries may only be entitled to income, whilst other beneficiaries may have some pretty immediate liquidity need, whether to fund education and so that will be the primary consideration when we consider ESG investing, is how does it impact? Does it impact in a different way on different beneficiaries?
Do you think that the fiduciary sector is getting better at having these conversations? They're coming up more frequently and there's more knowledge around how you can cater to clients looking at these styles?
So again, I think the whole ESG thing is kind of a new term, but it's been around for a long time. And my understanding is several decades ago, we already had clients who would say no tobacco stock, or no gambling, or even on the governance side of things, no dual share class, where some shares have more of a weight in terms of decisions. So it's not new. I think, there's more of an interest because the industry is talking about it a lot. The investment managers are pushing the dialogue. But I think those issues have been considered for a long time because families have had values and purpose for a long time, and therefore this will come into it.
Okay, many thanks. And Grant Wilson from Asset Risk Consultants, just to welcome you in. Hello there, Grant.
Thank you. Hello.
So just picking up on those points, if you're analysing investment managers that are investing for impact, how do you fulfil your duties in understanding what they're up to?
Okay, when we're working with clients, we tend to have two core things that we're working around. One is, as is very often the case, starting with the objective, what the client's trying to achieve. So what is the purpose of the money? And how is that purpose documented? Anything from a letter of wishes onwards. And we fit that into a framework, which I give credit to Bridges Capital for originally creating this spectrum of capital. A spectrum from, on the one hand, only considering financial risks and rewards, to the other extreme being philanthropy, where there are no financial risks and rewards. It's all about delivering the outcome, the non-financial outcome. And in between, adjacent to the philanthropy, is the impact. And that's where you're delivering metrics which are non-financial risk and return metrics, but are measuring what the purpose of this capital was. So firstly, understand where on that spectrum you are. And the next thing to deal with is the level of conviction, because many people have a view that something would be nice if it fitted in with the other objectives, but other people have red lines. As was being discussed about exclusions, and to say this is totally intolerable. And you need to know, in relation to the objectives, whether the level of conviction is extreme, or whether it's pragmatic, or something softer than that. And those are two important things that we use to put frameworks around what is still quite a confusing area, where people use commonly used phrases to mean somewhat different things. Does that make sense?
Absolutely. No, thank you very much for that. And just coming to Bernd Deacon from Berenberg, as a portfolio manager, Bernd, what's your take on the idea that you have to compromise performance to invest for impact?
Yeah, great. Thank you. Thank you also for having me. And yeah, from our perspective, like this impact topic and then also the financial performance should go hand in hand, as we see also these kind of longer-term impact targets and global kind of challenges more as a long-term growth driver for potential companies, like bringing in the area of like climate change, as a lot of investments also from governments are going there and companies can profit from this. So this is one example of this. But on the other side, you have to be very financially disciplined when selecting companies. From our perspective, you should not like jump on companies because just they look extremely dark green from this perspective, and then loosening your financially discipline. So from our perspective, it's really about like that we at Berenberg, for example, when we are investing in impact focused strategies, we don't want to loosen our overall equity selection DNA that we have in other non-impact kind of company strategies. So this is very, very important for us. And I think what is also very important to understand is regarding the definition of impact. And like when you talk about, I think, sustainability or ask people about impact, I think 90% of people at first just think about climate. But I think there are other challenges like demographic challenges, resources, water, like all these areas. And I think then this makes then also the investable universe wider and brings a lot of opportunities for the long term.
And is the information available about everything from the small caps through to large caps available for you to make these decisions all the way down to the SME level, or what's the opportunity for you to analyze these companies for impact?
Yeah, especially I think the biggest opportunities are actually the small mid-cap space, because these companies are very much undercovered, especially from an ESG perspective. I think everybody knows, or most people know about like this small mid-cap negative bias for smaller companies, because they don't have the abilities to disclose a lot of these sustainability information. So, and this is getting even worse on the impact side, because there it's even more challenging for these companies. So there, when you as a portfolio manager engage with these companies, looking at these companies, knowing them for quite some years, then you really know where the impact lies. And this is a company which actually contributing to solve one of our global challenges. I think this is very good and very interesting, especially these smaller companies, sometimes a little bit earlier, or really like in the space where they're solving some problems very early on.
Okay, thanks. And Richard, I mean, have you seen the wealth industry adapt its process to consider impact alongside returns? What are you seeing the impact being on the front line dealing with clients?
So the way that we look at it is this mysterious Z-axis, and to pick up a point that Grant made earlier, and to some extent also Melanie and Bernd, you've got financial return and financial risk is well understood, whether it's the investors themselves, the clients themselves, or the advisors they work with. This mysterious Z-axis, this impact measurement, continues to be an area of intrigue, really. And there are frameworks that are emerging, there are frameworks that have emerged, and I suspect there are going to be new frameworks that we don't really know about today, but they will come out in due course. And what that means is, the way we look at it is there's a big listening exercise with clients, and there's a significant engagement of just conversation around where a client's intent sits, where their value set is, what their purpose is, and so on. And I think so the big difference, and I don't want to be too grand to speak on behalf of the entire wealth industry, but I think the big difference is that you now have a platform, a basis from which both investors and investees can engage and have conversations. The survey showed that a couple of areas where confusion can still exist. We had ESG and impact used interchangeably by some of the answers. It also showed that, whilst there is a lot of data out there, perhaps we're still at the early stages of people getting comfortable that the data that is out there is a basis upon which they want to start making investment decisions. So really, for now, it's all about conversation. It's all about listening. And in due course, I'm sure that as the databases improve and become more established, then we'll start seeing that Z-axis have some quantitative data that people can reference through either precedent or from their own experiences.
Do you think things like COP26 and the media coverage that has been generated sort of confront clients and make them think about, well, what am I doing in this respect in terms of portfolio management, or is it those who are already attuned to it pick it up, and those who are less interested carry on in their position? What's your take?
Well, the survey touched on COP, and the survey also touched on what more than touched on COVID. And it was interesting to see, without trying to move away from the question, it was interesting to see how COVID certainly has increased people's awareness around the S in ESG. And COP and the statistics on COP is that there was a reasonable proportion, I think around 40% of respondents were optimistic that there would be some resolutions out of COP. So I think the answer to your question is, I don't think any one event in of itself changes people's opinions and awareness with how they want their investments managed. Certainly, it's a significant contributory factor, and And I don't think there are people out there who are all of a sudden going from 0 on ESG to 100% as a result of the events. There's a significant awareness around the issues associated with ESG. And maybe to finish with an anecdote, touching on a point around the data. You know, a family that we were speaking to recently presented in private the portfolio returns, and it was one of the next generation who came up with their own measurement of climate change impact, which had no reference to databases, but was incredibly thorough, well thought through. So, you know, the forces could be COVID, the forces could be COP, or the forces could be next generation. Difficult to say, and actually, in some ways, we could lose our focus by spending on thinking through the reasons why people are engaged. Without doubt, the engagement is high and is rising.
Melanie, is that something that you're finding too as a general trend in the fiduciary sector, the demand for you know, implementing strategies with ESG or impact focus?
So for now, the demand is still limited. And I read a survey recently, I can't remember who published it, but it's still less than 30% of private clients who express a strong interest in ESG. What we're seeing on the fiduciary side is going back to the spectrum that was mentioned earlier. It tends to be more exclusion centered in terms of what we're seeing in the investment policy statements. When you move forward to something more around measuring impact, I think one of the biggest challenge we face, and it's been mentioned, and there's mention of it in the survey, is the different data points that can be hard to reconcile. And in particular, there's very little agreement amongst the ESG rating agencies as to what good looks like. So if you look at the credit scoring agency, I think there's 98% correlation between the 3 major credit agencies. They agree on what a good credit score is. However, when you start looking at the ESG rating, depending on whether you look at Sustainalytics or CPD climate change or the MSCI ESG, you could very well have one company that scores highly on one and low on another. And that makes it quite challenging for clients to understand exactly how do they measure what impact they're having through their wealth. And I think a lot of clients still view that they can have more of an impact themselves than through their wealth, than through investment managers. So for instance, we may be asked to make a distribution for philanthropic purposes, thinking, well, I can have more of an impact in that way, or through my own business venture, because a lot of our clients are entrepreneurs and have businesses, than trusting my investment managers to have more of an impact. So I think there are still challenges. I would echo the point around COVID and the next generation. I think what COVID has done is it's really brought to the fore key man risk. And so it's gotten people thinking about, okay, I need to start transitioning this wealth. How is this going to happen? And the next generation's been brought in. And as mentioned, it tends to be a stronger interest. And so it's also a natural point to have those conversations, to revisit how the wealth is being managed. So that's what we're seeing for now, early interest, but not yet that it has translated into investment policy statements, including, for instance, the Sustainable Development Goals. It's more, don't include that, don't do this.
Okay, well, thank you for that. Grant, just to bring you in, I mean, we've discussed before around the challenges of metrics, measurement, but also, as Melanie said, like incorporating things into the investment policy statement. These are all fields in which you're working on a daily basis. It'd be interesting to get your view on those conundrums.
Yeah, we're definitely on a journey. Sometimes we reflect on the fact that financial accounting took a big step forward in the 1930s after the Depression and crisis. And in a similar way, the big data and the structuring around communication about these important metrics. And people use the Sustainable Development Goals as a framework for identifying what's of interest to them. the easy things are, one, to address the issue and start documenting it, and to accept that you're going to be reviewing that documentation regularly. We're nowhere near where we need to be, but people are making useful contributions. That spectrum of capital was a useful contribution. The same person who was the founder of that company, the Bridges, Ronald Cohen, is also chair of the Impact Accounting Committee at Harvard. And you can see how the progression is made to tighten up the data that's available and make it more useful and more transparent. Nonetheless, you've got important people like James Anderson of Baillie Gifford had a broadside at ESG the other day because the reporting data is not where we want it to be. So watch this space, document it, have the debate, and review what you've documented on a regular basis.
Thanks very much for that. And one of the key results on the Berenberg survey was around how much clients consider sustainable development goals. And Brent, I just wanted to bring you in to just think about constructing portfolios to achieve, meet certain SDGs. How possible is it to go out and try and meet those goals through construction of portfolios?
Yeah, very good question, because we hear this a lot actually. So I think one thing we have to consider here is actually that that the sustainable development goals are originally made for governments and not for investment purposes, for like selecting stocks, for example. So I think this is very important to understand, because when you look at these, you find that not all of them are really investable, and they're not really like good measures for companies and their products and services going forward if they can solve some global challenges. So I think this is very, very important. We have also, like from our approach side, find which kind of SDGs are investable, but also challenge this. And I think this is where these studies are helpful, also thinking like, what's the market thinking about this? Challenging our views with these kind of topics actually confirmed also our views that there's some which are really good, investable, and very robust, and some are, I would say, really like minor topics. And then I think regarding this, if you then construct a portfolio, and I think there it's extremely helpful if you are able to select from a wider range of SDGs which are investable. So then this can also bring a very robust portfolio through the cycles. And then you're able to invest from a very unique, very innovative kind of companies, maybe in the energy sector, to companies which are maybe transitioning from the old chemical industry, for example. So then this then makes then a lot of fun then to construct a portfolio for the long term.
Okay, thanks. And Richard, how do you see this as clients using SDGs as a reference point? Is it early days to see them incorporating these measures into how they set objectives?
The survey showed that if you're on the private client side, you're using the SDGs to help frame the way in which you want to consider establishing an ESG portfolio, albeit that's not exclusive. So to pick on the themes that both Melanie and Grant have mentioned, there may be people out there who understand that they want to engage in ESG, but may be less familiar with SDGs. Equally, the asset manager side, the professional investor side, are using SDGs to help frame the output of what they've been doing. So there isn't a winner in terms of the use of them. And as Bernd said, these measurements, the 17 measurements, there are 169 subsets. These were not put in for financial appraisal. So there's somewhere to go. The flip side is that they're out there. They are, relatively speaking, they're easy to understand, and therefore they do give a helpful way of framing what is a wide range of subjects. And the survey was interesting in that when you looked at the 3 most investable SDGs, they were considered to be SDGs 7, 9, 13. 7 is affordable and clean energy, 9 is industry innovation, 13 is climate action. But the most important were 13, 2 and 3, and 2 is zero hunger and 3 is good health and well-being. Now, 2 and 3 are clearly very important, but are difficult to frame within the database or the analytical frameworks and the processes that both Bernd and Grant and Melanie have touched on. So I'm giving perhaps a more complex answer to what is a simple question, merely to make the point that this is a framing that will remain, but I think there needs to be more work and effort to help empower clients and empower investors a way of being able to use it in the context of the reality of investment appraisal.
Okay, thanks. And Ben, just on the portfolio management side, when investing for impact, are you putting more emphasis on developed companies with developed market companies which have got a strong footprint around the world, or is there more impact associated with going for actually emerging market companies undertaking interesting and sustainable business practices overseas? Do you have to cover a lot of the globe to find the true impact kind of investments, or do you stick to an approach where you look at more developed markets? How do you even start to approach that?
Yeah, so it's really a mixture of this. So because as you're absolutely right, like in the developed markets or in the developing markets, you find different challenges, but you also find different kind of opportunities there, like areas like financial inclusion, etc. This is really a topic, like people getting access to the financial systems, like extremely cheap kind of and secure offerings here. This is something that's really, really powerful, which on the other side, maybe in the area of the already developed countries is not that of a huge issue. It's really it's an important topic, but I think especially at these kind of emerging countries want to develop, it's even more important. So you find like a very different variety of companies, and this is then also a beauty of a pure global kind of all-cap product that we are offering, for example.
Okay, thanks. I mean, one of the real hot topics in this area is transition finance, and as companies make their journey towards a more sustainable future, how stakeholders, shareholders should approach that. So perhaps, Bernd, I could stick with you to describe, I suppose, the Berenberg approach to owning companies that are making a transition to becoming more sustainable.
Yeah. On this topic, I think one thing that we are very clear on is that we have also been investing in companies with a more transition kind of story, is that we have to have a minimum level of sustainability. That you have to find already some areas that you're saying, okay, they are not too highly exposed to the coal industry currently because they are currently 100% in coal. But you have to already see some areas where they're moving from and what is happening. So that's, for us, it's very, very clear that there are some boundaries for us where we can invest in and where not. So typically these kind of exclusions, to then also show our clients in a very transparent way what they can expect from the portfolio as a minimum sustainability level. Regarding this transition stories, this is a very interesting field, especially as it becomes extremely powerful to talk to the companies, engage with the companies, support companies at AGMs, for example, and really bring also some views from our side to the table to support the management, and then also make aware of what we would like to see going forward. And it's not only for the companies like you would think about, like which are transitioning. It's also for companies where you think they have already a good offering in the area of sustainability, but they can do more, and encourage the management to focus here also and support the company here. So sometimes people think, the work is done when the company is analyzed and it's in the portfolio. I think then the heavy lifting really starts, like working together with the companies for many, many years. And as we are typically targeting investing in a company for a minimum of 4 to 5 years, then it's when it's getting really material from our perspective.
Okay, thanks. And Grant, I mean, how do you see pension trustees or endowments using influence, as Bernd said, to take that company on a journey?
Yeah, as Brent said, this is a process that's been underway for a while, and it's going to be running and running and running. I just reflect Stefan Schmidt-Heine, whose family made an enormous fortune in cement, in 1992, wrote the book Changing Course. He was the first chairman of the Business Sustainability Council. And of course, cement is something that you really want to change course from. So it's not new. 1992 seems a little while ago. And yes, more and more people are sensitive to the changes they want to see. And as Melanie said, they're comfortable now that not only is it good for the planet, the ESG targets, it's also good for risk controls. The more data that we have to manage the risks that are not just the financial risks in the portfolio, the better for long-term returns. So I see lots of it, yes, and it will keep running.
And it's quite interesting, I think, with in some pension schemes, the ability to use technology to reach out to members to get views on things, isn't there? Have you seen cases where people are adopting that so they can actually work out what people want?
We have, and there's a little bit of a challenge about structure, and structure is always very important, because if you don't have the legal permissions to do what you want to do, you shouldn't be doing it. And in many cases, the beneficiaries of wealth, say pensioners, are not the same people who hold the legal responsibility for making the rules, the trustees. And it may be that the pensioners have great difficulty communicating what they would like to happen to the wealth that is theirs, but is looked after by a trustee. So that communication between the ultimate beneficiaries, the people who've maybe put the wealth in there, and the people who have the trigger pooling capacity today, that there are some technological solutions for effectively polling software websites where the greater number of beneficiaries can let the trustees know what they think about issues that are current.
Okay, thank you. And
still a challenge.
Yeah, absolutely. Thank you. Melanie, I mean, if you see within trust structures, there's companies in ESG portfolios that are sometimes surprising to you because the criteria in which they're being judged. What do you see from this area of transition finance?
I think it's important to distinguish between ESG on the one hand and impact on the other. And ESG, I mean, there's some overlap, but overall, broadly, ESG focuses much more on the production side of things. So is something produced ethically? Are they paying their workers well? Is something grown sustainably? Is the packaging used recyclable, etc.? How are goods and services produced and delivered? Whereas impact investing focuses a lot more on the consumption side of things. Ultimately, what is the impact of the existence of this good or service on the world? And I think a lot of the beneficiaries that come to us, they feel quite passionate for them to raise it proactively. And so they have certain expectation. They think, oh, I'm going to do great on the world through my investments. And sometimes when they see the names in the portfolio, it can be counterintuitive. So it was a very large retail asset manager that came out with their top 5 ESG picks recently, and that included British American Tobacco and Coca-Cola. Now, without making any judgments, so to a lot of people, that's quite surprising to see British American Tobacco. It doesn't matter how sustainably the crops are grown, how it still doesn't feel like a product, a good that does good on the world. And I know they've recently acquired, I think, a health company, and but I think a lot of the dichotomy comes from that. And also, as a fiduciary, we see investment managers, we invite investment managers to do beauty parades. And I have come to learn now that pretty much any name can be given an ESG spin. And I've literally seen a particular name being sold to our beneficiaries as a good ESG stock, only for the next day another investment manager saying that same name was excluded on ESG grounds. And I think where we can help is helping beneficiaries to distinguish who's credible in this space, who's not, because it's very hard these days to find an investment managers an investment manager that does not talk about ESG. But to give you an example, let's say Coca-Cola, you can put several spin on it. You can say, well, they produce 146 billion or something of bottles, plastic bottles a year. That's not something I want to hold from an ESG stock point of view. Or you can say, well, actually, they own a lot of water and they bring drinkable water to the third world. That is something that I might want to own from an ESG perspective. So we go back to understanding the family, what's their purpose, what they value, and what matters to them, rather than an investment manager saying, well, this is an ESG strategy and this makes sense. And it tends to be that clients are more passionate about the impact on the world than the way things are produced.
Thank you for that. Richard, what's your take on this question of the ethical choices investors might make?
Oh, this is the hardest question of them all. Not so much on this in today's session, but just generally, I think it's the hardest question. When is transition finance acceptable? When is it not acceptable? So, without wanting to simply repeat or echo the sentiment and the answers made by the other panelists, it's a case-by-case basis, and over time, maybe some kind of precedent or some kind of model will emerge that will help people appraise transition finance dispassionately or objectively away from the manager that they work with or the managers that they work with. That's not going to happen for a while. We're seeing live in newspapers and in the press how different people have very strong different views of companies, and regardless of what the companies say. So it's a very tough question to answer. It's one simply that you have to do one-on-one, and then we'll see where we get to over time.
Okay, thanks. And just as we come towards the end of this session and before we open up for questions, it's really just looking at, I suppose, ESG strategies having become so mainstream. I mean, perhaps Bernd, I could come to you first just to say, isn't this just essentially a central approach for all managers? It's become, as Melanie said, so many investment managers are adopting these criteria. Do you think that's just the journey we're on in this space, to say it's just a way of investing that's productive?
Yeah, very good. Yeah, it actually is. I think it's very, very clear that sustainability and ESG risk management, these kind of topics, are very, very central to the long-term investment approach and to be successful. Because as we all know, these kind of topics on the sustainability side, if someone is not monitoring their factories rightly, or it's not paying their people in the right manner, this will not materialize tomorrow. But as a long-term shareholder, this will materialize in the next 4 or 5 years at some certain point in time, and then this will have an impact on the financials of the company. I think this is very, very clear, and especially COVID has shown how these things can materialize even faster, because then supply chains, labor rights are much more in focus. As with this health crisis, this has shown what kind of, or what employee situations we have on the world, which were mainly overlooked. So I think that's why, from my perspective, it's really, really critical to look at these kind of topics. But I think it's you see some level, I think, at most asset managers, but I think where it's getting really important is how you're implementing this in the investment process. And are you just basing your decision on some ESG ratings, or do you take your own views, make a deeper dive, and really understand what is important for the company and what is really, really critical for the risk profile of the company for the long term?
Thanks. And Grant, I mean, how do you see this as, is ESG becoming so mainstream that with any manager you talk to, you'll see them singing from the same hymn sheet, or what's your take?
Yes, it's certainly very popular, and almost everybody you speak to is a signatory to the UN Principles of Responsible Investment, which include the integration of ESG factors in the process of investing. So yes, it's very common. Like the rest of the panel, I think the really important thing is that relationship with the people who have settled the money, whose money it is. The manager needs to make sure that relationship extends into their values and the character. That is nothing new. As Melanie said, since the Duke of Sutherland in the early 19th century was getting into trouble for not looking after the people of Sutherland, investors have always felt the responsibility, and nothing new there. What is new is the data that is becoming more comprehensive, and the frameworks and the regulatory framework in which these values are expressed has taken a step forward and will continue to take steps forward to greater clarity and transparency. Does that make sense?
Thank you. Perfect. Yeah. And Melanie, I mean, you mentioned before that COVID has had an impact around key man, around people thinking about their mortality. But do you think that, as I said, ESG is now becoming so mainstream? Is there something about the conditions we're in at the moment that are going to prompt further changes in behaviour, or is this journey very gradual? What's your take looking down the road in the future?
So I think COVID has also emphasized the wealth divide, and I think there's a certain element of a lot of wealthy individuals got wealthier during the crisis, which is attracting scrutiny. And there's every government, whether in the US or the UK, there's the whole Build Back Better. And I think there is some element of reputation risk as well if private clients are not perceived as investing in a responsible way, given that they actually, for a lot of them, did relatively well out of the crisis. I mean, for now, I do question, okay, once everyone's adopted the framework and it's all on a level, will the world be sort of pollution-free, socially just paradise? Can we rely on sort of self-regulation? That is to be seen, but we are still seeing, I think, more of a supply push from the investment management industry than a client demand pull on those topics. And I think you have to reconcile that fundamentally. Investment managers tend to have an offering that they need to be able to leverage and critical mass. And so it needs to be fairly standardized, whereas private clients tend to have very unique values and sort of requirements. And it's reconciling those two, the very unique nature of private clients versus the standardization of the investment management industry, and where do the two meet. I think as fiduciaries, we're not there to pass judgment one way or another. We are there to implement our beneficiaries and settlers' wishes, which again tend to be quite unique. So how do you reconcile the two?
Thanks. And perhaps Richard, do you have a take on that challenge of being able to provide a tailored solution that's also, scalable?
Well, it's very tempting to get onto the sort of Berenberg pitch mode, which I shan't do. But of course, as an investment manager that is a stock selector, we have the ability to tailor portfolios orientated around clients' own wishes, and every discretionary mandate is a contract between us and a specific client, rather than a one-size-fits-all approach. And that's worked very well. It's worked very well before people talked about ESG, because of course clients do want the ability to occasionally, and sometimes very frequently, depending on where we are in the world and where we are in the market, to be able to tailor their strategy to suit their purposes. And of course that additional level of flexibility is critical where you're starting to align against specific interests. We have faith-consistent investors who will have a very different set of ESG requirements than maybe others out there. But I to pick up the point earlier, I don't know where the big demand will come from in the future, whether it will be investment managers proposing more ESG strategies to their clients, or whether clients are looking for it. I just think that everybody needs to be conversant on the subject and be prepared to engage in a way that goes beyond the old school rules of X and Y, to pick up the point I made earlier. And that's a really exciting place to be, because it makes it a more meaningful conversation around what's your money for, you know, what do you want to do with it, where do your responsibilities sit. And as somebody who spends much of my time talking with clients about those subjects, it makes for a much more rich and dynamic conversation and a much more meaningful relationship. So, you know, it's an exciting time to have this component. It doesn't make it any easier, as we've touched on earlier. So, you know, it's the future's exciting, but it's probably going to get more challenging.
Well, thank you for that. And we look forward now to taking questions live in our webinar from our audience.